Welcome to The Explainer. Today, we're going to decode how two companies, identical in every single way, can tell completely different financial stories. We're talking about how the accounting rulebook they follow can totally change the way they look on paper. Okay, so here's how we're going to tackle this. First, we'll start with a little mystery. Then, we'll introduce the two main characters in our story, GAAP and IFRS. After that, we'll get into the nitty-gritty of their differences, see how that messes with financial analysis, and finally, give you a playbook so you can make a fair comparison. All right, let's dive right in with a puzzle that, honestly, can trip up even the sharpest investors out there. Seriously, think about it. You've got two manufacturing firms. Same factories, same products, same sales. They're basically clones. But then you pull up their balance sheets, and whoa, the European company looks way richer in assets, with a much stronger equity position. How is that even possible? Well, it's not some kind of financial wizardry. It's all in the accounting. So to solve this little mystery, we need to meet the two main players behind the curtain, US GAAP and IFRS. You can think of them as the two major accounting languages spoken across the business world. Now, the real difference between these two comes down to their whole philosophy. US GAAP, think of it like a super detailed recipe book. It gives you precise step-by-step instructions for pretty much every situation. IFRS, on the other hand, is more like a set of guiding principles for a master chef. It's less about rigid rules and more about trusting the accountant's professional judgment to cook up a report that shows the true economic picture. Okay, this is where the plot really thickens. Let's look at a few specific examples of how these different approaches can paint two wildly different portraits of a company. First up, inventory. US GAAP allows something called LIFO, which stands for last in, first out. It assumes the last things you bought are the first ones you sell. Now, when prices are rising, that means you're expensing your most expensive inventory first. The result? Lower reported profits and a lower value for the inventory sitting on your balance sheet. IFRS just says no. They argue it doesn't reflect how businesses actually operate, so they ban it outright. And you see that same kind of thinking when it comes to value recovery. So let's say there's a market dip, and you have to write down the value of your inventory. If that market bounces back, an IFRS company can actually reverse that write-down and show the asset's recovered value. But under GAAP, nope, it's much more conservative. Once that value is written down, it stays down, period. Now for a really big one, property, plant, and equipment. This is a game changer. IFRS lets companies revalue big assets, like a factory, to its current market value. So a factory that was built 20 years ago can suddenly look way, way more valuable on the books, which gives a huge boost to both assets and equity. A US company using GAAP, however, has to keep that same factory listed at what they paid for it back in the day, minus depreciation. And we see another huge split with development costs. So imagine a company drops millions developing a hot new product. Under GAAP, that's an immediate expense that just hammers profits right now. But under IFRS, if certain criteria are met, those exact same costs can be put on the balance sheet as an intangible asset. They get expensed slowly over time, which makes the company look a lot more profitable and asset-rich while they're in that development phase. Okay, so we've seen all these differences, but why does any of this actually matter? What does it mean for you when you're trying to figure out if a company's a good investment? Let's connect the dots. The scary part is that these accounting choices can completely warp the key financial ratios we rely on. You see it right here. An IFRS company revalues its assets, and suddenly its debt-to-equity ratio looks fantastic, much healthier. At the same time, a GAAP company using LIFO might show a weaker current ratio, which is a key measure of its ability to pay its bills. The bottom line is, if you just compare these ratios side by side without making adjustments, you're not comparing apples to apples. You're comparing apples to, oranges with a different paint job. So the big question is, how do we solve this? How do we cut through the noise and actually conduct a true, fair comparison between two companies that are playing by different rules? Your playbook has to start with one simple question. Which language are they speaking, GAAP or IFRS? You've got to dig into the footnotes to find out. From there, you can start to make adjustments. For that IFRS firm, you're going to look for those revaluation reserves. For the GAAP firm, you need to see if they're using LIFO and try to figure out what their numbers would look like without it. The whole goal is to normalize the data so you're making decisions based on economic reality, not just some accounting fiction. And all of this leads us with one last really big question to chew on. As our economies get more and more tangled up together, does it really make sense anymore to have these two competing financial languages? Are we eventually going to land on a single global standard so that a company in Texas and a company in Berlin are for real, telling the exact same story? That's a debate that's still raging among accountants and regulators all over the world.